Good day, everyone, and welcome to today's macro and crypto-focused webinar, The Debt Supercycle and the Fiat Endgame, made possible by Amberdata. I'm Andy Baer from Coindesk Indices. So if this were a film title, a moviegoer might expect an apocalyptic action movie more than a rom-com. The stakes appear pretty high. Using your best imagined preview voiceover, the sort of in a world where kind, ask yourself the following question: what's a scarier future macro picture? Bitcoin worth $1 million or Bitcoin worth nothing? Today, our esteemed group will zoom out and take stock of the cumulative and aggregated effects of central bank and fiscal policy over the last few decades with a focus on Japan. We'll explore how precarious the debt supercycle has left the world and how Bitcoin as a critical piece of financial market structure is expected to function, behave, and serve. Next, we'll fold in geopolitical risk, a potential accelerant to these issues. I'm excited to work with these panelists whose pre-crypto backgrounds in a variety of traditional asset classes, derivatives, and thought leadership gives them a perspective and tools to have and share informed views. So we welcome audiences to ask questions. And now it's time for me to welcome our panel, and I will start with Greg.
Thank you so much, Andy. Happy to be here. Just want to introduce Amberdata and myself. So I am the Director of Derivatives at Amberdata. Our tool set at Amberdata is extraordinary, helps our customers essentially find opportunities in the market, both on a blockchain level and a market data level. Our derivatives data is the best in the business, but we also have blockchain data, market data in terms of spot prices, and DeFi data as well. So this is going to really help people make actionable decisions. And this discussion today is really about setting the tide of the macro environment that's going to sail the ship of crypto going forward. My background is as a proprietary trader. I've been trading for about 15 years, and I was a co-founder of crypto derivatives platform Genesis Volatility before joining Amberdata.
David, could I ask you to introduce yourself, please?
Yeah, hi, David Brickell. I'm head of international distribution at FRNT Financial. FRNT is an institutional cap markets and advisory platform focused on digital assets and web-based financing. You can think of it essentially as a kind of full suite investment bank service offering into the digital asset and web-based finance space. I've been involved in crypto professionally for about 3 years, involved as an investor for about 10. Before that, spent around 18 years as a sort of macro sales and trading across some of the biggest investment banks. I also write a newsletter, a macro crypto focused newsletter called Connecting the Dots for London Crypto Club. And that's my involvement.
Thank you, David. Imran, delighted to have you with the group. Can you give us a bit of your background, please?
Sure. Thanks for having me. So I'm Imran Lakha. I've been a trader for over 20 years. I was on the institutional side, ended up running a few desks for some of the banks on Wall Street in equity derivatives. Also spent some time as a portfolio manager trading macro options on the buy side. And now I'm the founder of Options Insight, which is an education firm where we teach anyone and everyone about options and how to trade them. And we also write daily and weekly research around what we're seeing in options market in cross-asset macro, and that includes crypto, which I jumped into the crypto options market in 2020. So we've been doing that for a few years.
Thank you. Greg, you teased a little bit how Amberdata can help us think about the topic ahead. Do you want to give us some more details?
Yeah, absolutely. All right. So Amberdata has multiple data pillars, including blockchain data, market data, such as spot and futures, perps, and options, and DeFi data. One of the things that's really interesting about a new asset class like this is that how do we interpret that data and find essentially actionable opportunities by combining all these data layers is it's still like a game to be figured out. So there's a lot of data nuggets of value in there. So combining everything in one place is very valuable. Talking about some of the data assets that we have today, we'll talk a little bit about derivatives and what we've seen in the market. And so really Bitcoin has been a really interesting asset this year so far. the way that it's been behaving. Looking at this chart here, this is an Amberdata chart. What we're looking at is the performance of Bitcoin versus the performance of ETH. And we see two notable events, the SVB banking crisis and then the Middle Eastern tensions and war going on. And so we see post-SVB banking crisis, Bitcoin outperformed Ethereum and continues to outperform it. And then same thing with the Middle Eastern crisis. We saw a rush to Bitcoin and Bitcoin outperformance in response. One more quick note here is that the way that Bitcoin is behaving, this is a spot vol chart. It's behaving as a safe haven asset class so far in 2023. When the world's panicking about something, Bitcoin has been rallying with a lot of volatility to the upside in response. And this is an attribute or a property of a safe haven asset. And this is really what we've been seeing so far. So it's going to be really interesting to set the macro landscape in terms of the monetary policy and the geopolitical policy and really see how Bitcoin is going to benefit or not from that.
That's fantastic, Greg. And that narrative of a safe haven asset, it just helps correct some of the perception of all cryptocurrencies as kind of very speculative risk assets, really kind of redefines how a new and trustable monetary object can function. When I was a young student in the late 80s, the thing to do was study Japanese, right? Because this was a booming economy. This is where opportunity would be endless. I've top ticked many things, but top ticking the Japanese economy is something I'm very proud of. Maybe it's a good idea to think about or to start to explore why we think about Japan as sort of the grandfather of all quantitative easing and the grandfather of all current central bank kind of personality.
Yeah, absolutely. Just kind of briefly setting up this picture, Japan had its financial bubble 16 years before the rest of us. And in response, Japan lowered interest rates. Now they have a negative interest rate policy in order to essentially reflate that bubble. We're now in this world where Japan has fixed their interest rates very low. The rest of the world is raising rates to combat inflation. And so now we're at the breaking point of where does Japan go from here? Is Japan the canary in the coal mine as the rest of the world diverges? Really, in the debt supercycle, private debts become public debts. Public debts then becomes financed by central banks. And to me, the yen is essentially the breaking point. The central bank can control the bond market or it can control the fiat currency, but it can't control both in a free-floating market.
David, in your career, which really macro and multi-asset focused, how did you think about Japan, maybe when you started, and how do you think about it now? And what kind of wisdom have you built up in support of this idea?
Yeah, well, I think to Greg's point, Japan was kind of, that sort of first major asset bubble that burst. And then, the response that it invoked in QE kind of led the way on that being a policy. And there's similar dynamics too in terms of what you've seen in the Western world and what I call the Japanification of the Western world of ever increasing debt required to power growth, and also these sort of kind of deteriorating demographics which impede the ability to grow these economies. I think one of the things that's interesting for me is when I think about Japan is the interconnectedness of the global financial markets. Obviously, Japan themselves are the largest creditor nation and the largest foreign holder of a bond foreign holder. So when Japan's market starts to move, it has massive ramifications globally for global assets and particularly global bond markets. And I think the interesting thing when you look at Japan at the moment is Japan's been pursuing this yield curve control policy to basically keep a lid on rates. And effectively in doing that, they're expanding their balance sheet by printing to buy up those bonds. In doing so, they've decimated their currency, which is now obviously becoming problematic. So now they're at this crossroads where do they continue to pursue this kind of unsustainable policy of yield curve control and just see the currency continue to get decimated, or do they pass that baton back to the Fed and other global central banks to be the ones to start keeping yields under control and then start to sort of debase their own currencies versus the yen.
That's interesting. It challenges the idea of a central bank when, it's only a central bank locally, not globally when push comes to shove. Imran, is we share a background in equity derivatives, and one of the curses of that is that we only start. Sometimes we're having more fun when other people are experiencing pain, right? And when other people are nice and relaxed, we find the market kind of in a reduced opportunity state. How have you thought about Japan? Before we get into the more modern post global financial crisis era of central bank activity, how did you grow up thinking about Japan, about its derivatives markets, and how it was responding to this kind of early QE behavior?
Yeah, so Japan has got a tendency, in terms of how the Nikkei behaves, has a tendency to move quite violently to the upside. So like most equity indices tend to have a negative skew where volatility rises when the market goes down, and when the market goes up, volatility falls. Now, a lot of the Asian indices kind of flipped and saw quite extreme volatility to the upside. And Nikkei is definitely one of them. So we have had episodes over the years of where the Nikkei breaks higher and takes volatility with it, similar to some of the things we see, and we're going to talk about in Bitcoin and safe havens in general. So that's one thing that's definitely stands out in terms of how Japan has traded historically. In terms of what's kind of going on now, if you look at the dollar yen and how the volatility surface is kind of moving around on that thing, it was interesting that since sort of the end of last year, people were starting. Obviously, there had been a crowded trade to short the yen. People that was the biggest macro trade of 2022, right? To short the yen, catch that massive run up in dollar yen. But then once we got a wind that the Bank of Japan were going to start to maybe relax some of their yield curve control, the options market cottoned onto that. And there was quite a lot of downside being bought in dollar yen because the expectation was that you get this sudden repricing higher in the yen. And over the course of this year, that just hasn't happened. So even though you've had the yield curve control gradually being managed higher in terms of rates, we never got this massive move up in the yen. And that's to do with partly what David was talking about, is how interconnected everything is. So even though they've let Japanese rates move higher, they've kind of controlled it with sporadic bond purchases. And at the same time, US yields just absolutely exploded because they became somewhat unanchored. And that's why the dollar yen has continued to rally and the yen's continued to get crushed. So, and the options market has almost given up on the idea that the yen's going to get a load of appreciation suddenly with intervention, because all that downside skew that they were pricing has kind of gone away now.
It's really interesting. Let's think about now the rest of the world, or at least the US and Europe, joining in on the same kind of playing from the same playbook after the financial crisis and the period since then. So let's talk about sort of post GFC all the way up through, let's say, COVID fiscal events, and see how the dynamics have changed as the US Fed and other central banks kind of joined in. Now, David, is that when your, I guess, idea of central banks not really being able to act independently really started to accelerate?
Yeah, I guess so. I mean, obviously, the Fed and the US dollar is central to the global financial system. For all the talk about de-dollarization, that if that was to ever happen, that's going to have to play out over a long time. There's, I think it's something like $17 trillion dollars worth of debt is issued outside of the US. So certainly, if you see kind of asset bubbles sort of collapse, the debt level remains the same; it doesn't change. So actually, the first move in that kind of end of world scenario is that there's a scramble for dollars to sort of pay those back, which is what you see when COVID in 2020, when that first hit, straight away you see the whole dollar banking system kind of freeze up. And then the Fed are then forced to come in and be the suppliers of that liquidity, and they extend these swap lines around the world because everyone around the world is trying to sort of grab hold of dollars. So I guess this has been building, and you can, whether you go back to the sort of petrodollar ideas and that dynamic, or post Bretton Woods, the Fed and the dollars, kind of play this increasingly important role in the global financial system. And I think for me, and when I think of Bitcoin and everything changed the financial crisis in 08. That was probably like the reset moment for the US and the global financial economy, where they needed this debt bubble to hugely deflate. But obviously that would have been a massively difficult transition, and you'd be looking at depression and lost decades around that. So they came in and they artificially inflated the assets because that was the collateral that underpinned the entire financial system. And now we're stuck in this kind of game of almost cat and mouse where they want to normalize, but this global financial system is addicted to this liquidity. And as soon as they start to withdraw the liquidity, quite quickly you start to see things break. And I think we've started to see that over the last year.
And probably what didn't help was several $1 trillion of fiscal stimulus that was necessary, but not necessarily helpful from the pandemic. So, which led us to last year when you really had just such violent moves, such violent Fed policy to raise rates that I still don't even know if the world has really grappled with. Certainly, a lot of people weren't professionals or maybe even alive the last time we saw rates here. And then that leaves us susceptible to unexpected consequences like Silicon Valley Bank, Greg. So, what kind of precariousness existed then, and what did we learn from that crisis that really we may not have been prepared for?
Yeah, definitely. So in response to COVID, the central banks essentially expand their balance sheets. This to me is a very interesting chart here. If we look at the balance sheet to GDP of central banks and how quickly they kind of increased their exposure after 2020. And so this led to some inflation. So this is sort of the fiat response is inflationary. And so when the Fed goes to raise rates, essentially banks and owners of treasuries get net present value losses on their bond holdings. And so held to market maturities, which treasuries have, are very safe collateral, so banks can hold them on their balance sheet easily. When the present value losses come to their balance sheet, even though it's held to maturity, it wiped out the capital structure of Silicon Valley Bank, as well as other small banks. And now the Fed has to step in with an emergency loan program where you can go ahead and post your bonds at present value and get a loan back at face value. So the losses just go back on the central bank. And that's really what I see here in Japan. In Japan, rates are locked at zero and the ownership of JGBs are domestically owned, like 90% of the JGB market's owned domestically. So if they did raise rates, the present value losses hit directly into their own economy. And then they would have to do some sort of emergency loan program like this anyways. And so you're back to the yen issue or the currency issue. Fiat is sort of the last domino in the trail of passing the hot potato of losses forward. And fiat is the final point. And that's what we're seeing here. And that's what we saw with Silicon Valley Bank.
That's interesting. So to summarize, it's pretty bad when a regional bank can get caught long duration in a bond sell-off. But what would be worse is if an entire population gets caught long duration, and rather than bailing out a bank, you have to bail out the entire population. And it feels like the ammunition from the banks is getting closer and closer to being empty. And rather than have things slow down to allow healing, you get all these accelerants. We get all these accelerants that speed things up. So Imran, you run an education service. You help to educate people about options, which is of course doing God's work and helping people understand curvature, convexity, and payouts. And while they're doing that, they'll learn about proper funding and forwards and things like that. It just strikes me as if anybody who was around, I think I made this point a little bit earlier, has never been in a world where interest rates have gone up so violently, and not been able to see around corners to see what the effects have been. How is this kind of impacting? First of all, I think volatility levels, all said, have remained pretty low. Is that a supply demand effect? Is that the fact that people just don't understand how precarious things are? Why are things so calm? And do you think that people may not have a rearward looking enough perspective to know what's at stake?
So the point you make about rates, I totally agree, right? Most people who are trading now have never seen a rate cycle like this. Like the speed at which rates went up and the amount of rate volatility that we've seen, right? So the MOVE index trading at historically very high levels relative to things like the VIX. No one's really been in that environment before. But one thing that's clearly evident when you have high rates volatility is you get a lot of dispersion. You get a lot of dispersion between sectors, because some sectors like rates going a certain way and some sectors hate it. So rotation has been the name of the game. So you've seen record levels of low correlation between equities this year. And it's been not only realized correlation, but implied correlation as well. So realized correlation because of what I've said about rates moving around a lot and that making different sectors do different things. But you've got such a large supply of index volatility that keeps coming to the street and providing all the market makers in the S&P, which is obviously the main index that is traded in equities, they're all long volatility. So they keep getting given loads of S&P vol, and in the single stock world, you've got a lot of buyers because people are playing stories, people are playing NVIDIA and the AI names and stuff like that. So you have a big retail force plus institutions who are buyers of single stock options, and you have a structural supply from structured products that are yield hunting products and general overwriters who own the market and want to sell calls against it. And that is compressing index vol relative to single stock vol and creating this massive dispersion.
Right. And it's a superb point because a reinflation of rates was what the market did need to help companies differentiate their process, right? Their funding requirements, their growth requirements, help separate growth and value a little bit better, and even the playing field for a lot of factor investors. That's true. But in the context of this conversation, where we kind of all are looking at the sky and we see very, very dark clouds as central banks and the whole money system is running out of options, are we too complacent, and are people just kind of playing a short game, especially things like selling options for yield, when they at least should be thinking about, well, what do I take for granted in terms of safety right now, right? That's the real question. And I think that's what leads us maybe back to Bitcoin. David, what do you think? Are we still kind of trying to play a short game and remain relatively unhedged for the medium term?
Yeah, it's an interesting question. I actually feel that the actions of central banks post the GFC, they've essentially removed, in my mind, the left tail risks for markets. And I get a lot of pushback when I say this, and I'm kind of seen as a bit of a perma bull. And again, for me, it's less about the assets going up as this currency debasement story that's constantly going on. So the sort of denominators sort of falling in value. But I think with, like, if I look post financial crisis, we had obviously a big fiscal response to that. We had QE. Then there was a fear in the market for quite a while about, okay, particularly in Europe, where they were hitting against these GDP debt GDP constraints, that if there was another crisis to come along, there'd be no fiscal room, there'd be no room to maneuver. And then we had 2020 happen. The world kind of blows up. The world stopped, and they just went in and went on a massive fiscal splurge and kind of threw all those rules out the window. And we're happy to do that. And then obviously accompanied by easy monetary policy. So then you start to go, okay, well, so then they've obviously had to jack up rates in response to the inflation that kind of caused. And then you go, okay, well, things are going to break. So then you start to get a little bit nervous about things breaking. Things did start to break. We actually saw it over here in the UK with the gilt market. And in the midst of a hike cycle, the Bank of England come in and did like emergency QE, basically. And And then we saw it with the regional banking sector in the US in March, and straight away within a couple of weeks, the Fed have expanded the balance sheet 400 billion and backstop that. So they keep when these bubbles sort of pop up and this game of whack-a-mole, they keep, they have the mechanisms in place and the willingness to now use them to artificially support these markets. So I kind of think that for me, that's what keeps volatility dampened, and it's really, really difficult to be a bear in these markets. And so therefore then brings you back to this fiat debasement story, and then, well, how do we play that? Because how do we play this blow up? And actually what you do is you kind of play, for me, that the upside move in Bitcoin, and maybe that's the trade.
Right. So let's move on to that, because the currency debasement, I guess, event or outcome doesn't feel like a drift, right? Doesn't feel like something that you would look at over a chart over months or years. It looks like something that happens as a surprise in an accelerated way, right? And in a way where it's either too quick or too massive for central banks to come in and wipe out, right? I assume I'm capturing that notion correctly, and maybe we can get Greg's thoughts on this. Like, how does that happen? How is Bitcoin or are other safe havens mature enough and scalable enough to function in that way? Like, let's kind of play this out a little bit, and think about what happens.
Yeah, so I like to say this saying a lot. It's bankruptcies happen slowly, then they happen all at once. And so I think we'll have this same type of like debasement catalyst. Right now, the way that debasement happens is it's kind of slowly, again, passing the hot potato of losses to essentially the fiat system. But then, what's the real catalyst to like move this into sort of a hyperbolic phase? And what I really like, this kind of brings me to sort of potentially geopolitical risk, is when we look at deficits today, deficits are in the area of World War II deficits when we're actually at war. And for the most part, we're in sort of peacetime territories. And so as kind of conflict arises, we're seeing that in Eastern Europe, we're seeing that in the Middle East. Again, those are still kind of regions that are somewhat remote from us. But eventually, if that spreads, and the big one is sort of Taiwan in the Asia Pacific area, that could be a potential catalyst for some sort of monetary debasement. And so real quick, the way that I think about this is if we look at investment in military, worldwide, it's 2.4% is the average percentage of GDP. The US is sort of the leader in that at 3.5%. But if we look at a country, back to Japan real quick, that has essentially post-World War II, no military and guaranteed protections from the US, while they're underinvested in their military. And if the US is supporting two other wars and they need to protect themselves, well, just assume that they needed to pay 2.4% military funding for themselves for the past 20 years. Well, now they have a 20% deficit, you could think of past unfunded military spending that they have to ramp up. Well, they're already at that inflection point without some sort of conflict. So where does that put us? And that's really kind of what I see as the true catalyst for debasement is global conflict. And not only is that Bitcoin a safe haven in terms of prices, but it makes Bitcoin a safe haven in terms of perfect portability. It's hard to leave the country with gold bars in your pockets. It's easy to do that with Bitcoin in your head.
That's a great point. It reminds me of a point, Imran, that you made during our prep call, that you helped make this connection in my head between the COVID fiscal spending was a little bit like military spending, but just under different circumstances. And I think clearly the world, as David pointed out, broke a few rules or bent a few rules to be able to infuse the global economy with that many trillions of dollars. But people were pretty happy to get it and not in a mood to fight or be angry, right? Or be in a mood to be alive and continuing to be alive. Can the world handle another multi-trillion-dollar spend in military when people won't be happy? And that may also be associated with less, I guess, altruistic levels of austerity and unhappiness coming so soon after 2020. Do you think that has the scale to tip currencies into a debasement kind of a tailspin?
So, I mean, I definitely think there's been a change this year in the way Bitcoin has traded relatively to stocks, for example. So when we were going into our tightening cycle, that in my mind was a political thing, right? It was led by a political need to bring down goods inflation, energy inflation, and that's what was driving it, right? I don't think the powers that be mind asset price inflation. But the problem was when the inflation shows up in the CPI numbers and people get angry, then the way you calm that down is by hiking rates. So that's the world we were in, and that took equities and crypto markets down together. So you had a very high correlation, as high as like 80% on a rolling 1 month basis last year. And since the start of this year, particularly when the SVB crisis happened, that really started to change, because you started to see that people genuinely saw crypto as an off-ramp. They were worried about the fiat system. When banks go from being fine to blowing up in 2 weeks, what's going to happen next? So people really started to get scared, and you started to see that in the price action. And you saw the breaking down of correlation between equities and Bitcoin in particular. ETH was not really having the same impact. Maybe it's going to start to now, and we can talk a little bit about that later. But we saw correlation go from 80% to, like, this summer, it got to 0. And right now, in the last month, it's flipped to negative. So this is definitely something that has happened over the course of this year and should attract particularly institutional investors who have exposure to stocks to then allocate to this space, because at a negative correlation to equities, it's clearly going to help your risk-adjusted returns.
So that's I think an important bunch of observations that even to hedge or position against a unlikely or what would still be characterized as a surprise outcome or an accelerating outcome, even just starting to position that way in a couple of percent in large portfolios in an appropriate way would certainly provide tremendous support to Bitcoin. And then you might even have the accelerating, right? Options people know it's all about, right? Acceleration and correlation are things that we think of at the same time, right? That people would start to accelerate their holdings. David, what scale is possible right now? Think about accessibility of Bitcoin, how people with serious money would start to accumulate that. And let's say they started to think about, maybe 2-3% that accelerates up is not an inappropriate thing to have, given that support, given where rates are, given what these the precarious nature of currencies are. What kind of scale can we develop here, and how would people tend to hold it, do you think?
Yeah, I think that's why the sort of BlackRock ETF news for me is like really important. And yeah, I get questions now like, have we priced all of that in? You argue we have, the headline of it we have, but what we haven't priced in is there's going to be a real flow dynamic. So right now, speculatively, yeah, we've probably priced that news in, and I imagine as soon as you get a spot Bitcoin ETF actually approved, then we actually kind of sell that news, if you like. But over time, that's going to sort of draw money in. So I certainly think when you think of the piles of money sat in pension funds and wealth management platforms that won't be able to just hold in and of itself Bitcoin, these spot ETFs are going to be super important for allowing that money to come in. So I think that's going to be sort of one sort of big avenue where you're going to see money come in. And then I think it's amazing for me, given the issues we've had around the frauds and FTX and this type of stuff. For all that's gone on over the past year, I think given this macro backdrop, the fact that we're seeing Bitcoin emerge as this flight to quality asset is just huge. So in terms of scale of this, I actually think we're actually on it feels like we're sort of moving at a quicker pace. Now, obviously, in terms of allowing that adoption and the money to come in, there's lots to resolve in terms around sort of custody and sort of counterparty risk and all this stuff. And to say, as someone involved, day to day in this, you see how much and the energy that's being put towards, making these robust systems to allow this institutional adoption and just broader global adoption. But it's I think it's this next bull cycle that we're now, I think, in is, I think, it's going to be defined by this institutional adoption, and I think it's hard to even get your head around what the numbers might look like around that.
That's great. We got a question here. I agree with your comments there, David. So we have a question, and it's an interesting one. So is it fair to say that you all, I'm just asking questions, but that you all are Bitcoin maxis? Can you see a scenario where something like Ethereum and is more multidimensional and potentially valuable, meaning ETH is an ecosystem that can be used for a million products and platforms? So, and I think, Imran, you touched on Ethereum and Ether. Do they fundamentally serve different purposes? Can they be thought of as both, in a way, stores of value, whereas Ether, you actually know how to spend it? Or is a predictable future of rareness the most important thing to have, or simplicity? What's most important? I'll hit Imran first, and then I want to ask Greg that question too.
Sure. So I think for sure that there's different use cases here. I think this year has shown Bitcoin has kind of emerged as a bit of a safe haven, and a diversifier, and kind of will protect you from this debasement story. And ETH might have some of that as well, because arguably it's deflationary, right, and limited supply. But ETH is very much a tech play still as well, because of the innovation that's going on in ETH and what's being built on ETH. So there's much more of a sort of tech speculation angle to investing in ETH, in my mind, relative to Bitcoin, which is still innovating to some extent in terms of Lightning Network and things that are going to happen, smart contracts that can happen on it as well. But it's established itself as that hedge to the fiat system, and that's what it's behaving like. Now, I would say the options market in crypto has started to give ETH a bit more respect in the last month. So the whole of this year, ETH was just not loved at all. It was all the Bitcoin narrative. That's all anyone cared about. And in the last month, we've started to see, as we get closer and closer to a Bitcoin ETF being priced in, as David mentioned, ETH is the next story. And with the filing of the BlackRock ETH ETF a couple of weeks ago, we saw that knee-jerk move higher in ETH. And ETH has kind of been left for dead by Bitcoin this year. And therefore, there's a big catch-up trade potentially there. So you will see a lot of interest come into ETH from the speculative side, and just to say, okay, well, if there's an ETF coming on that, what is the price impact of the flows that are going to come from that? That's going to be massive for ETH because it's a smaller asset anyway. So I definitely think there's a case for both. But fundamentally, they do serve different purposes.
That's a great point. I'll just add in briefly. I love looking at Ether volatility and the shape of the skew, and love seeing the return of some upside skew. It's also interesting to look at the volatility and the movement of the staking yield in ETH as kind of another way to gauge surprise network demand and volatility. They have an interesting kind of correlation profile, the staking yield and the vol and the price of ETH, all quite interesting to look at together. Greg, what's your feeling on our focus on Bitcoin, on access, on size of opportunity, and how it starts to unfold? And also, I'm curious your idea on the sell the news kind of price action that I think a lot of folks feel is possible in the next couple of months.
Yeah. So I like that. The sell the news, buy the rumor, sell the news, classic sort of trader base case. I would not step in front of this train and sell Bitcoin post news event. To me, that's I think the flows that we're going to get, as David talked about, are real. Bitcoin right now, the market cap is $750 billion. Total wealth under management is about $145 trillion. So, I mean, if you just think about the wealth under management these people haven't really allocated to Bitcoin yet. You add 1%, that's 1.4 trillion. $1 trillion market cap puts you at 50K right away. 2 trillion puts you at 100K. So I think there's a lot of potential for upside movement. Kind of to your previous discussion, Bitcoin versus ETH. To me, Bitcoin is digital gold. ETH is the tech place, is NASDAQ, as Imran said. NASDAQ, you can think of individual companies as individual protocols building on top of ETH. The big issue with ETH right now is sort of the regulatory landscape. If they're going to come after every DeFi project that's built on ETH and throw the founders in jail, that will definitely destroy the value prop of ETH pretty quick. Bitcoin is considered a commodity. It doesn't face those same problems. Obviously, these are global assets. So if our jurisdiction isn't playing nice, then people can go elsewhere. But I do think a lot of wealth is driven by the US, and a lot of the market dynamics are driven by US. So I think that's going to be sort of the bifurcation. And then here's just kind of a chart of the Bitcoin gold ETF. Obviously, there's more dynamics than just launching a Bitcoin of a gold ETF going on here. But I do think this is a good sort of roadmap for a Bitcoin ETF launching, and essentially $145 trillion of wealth, allocating a couple percentage to Bitcoin. 100K is not a big deal. The world goes on. No one would even notice. We would just be having this conversation with Bitcoin at 100K.
Do you all, this may be a touch on the sacrilegious side, but do you all feel as if the success of an ETF and the feeling that people feel that they have this, I guess, directional protection by owning an ETF, does it start to violate this idea of portability and 24/7ness, and or do we feel as if, look, the sun's going to come up, buildings will remain erect, and really we're talking about a safe haven asset that will hold its value, whether it's sitting in a brokerage account as well as in a cold wallet? David, what do you think about that?
Yeah, I mean, I kind of like when you think of like the safe haven aspects, I mean, it's the same sort of for gold. Like you're talking about like these real end of world scenarios. And that's a reason that some will hold it, and some will have their gold sort of buried in the ground somewhere. Others will have their Bitcoin in a cold wallet, and they're really holding it for those kind of that kind of paranoia and end of world scenarios. Others will just want exposure to see like the safe haven sort of quality of it, but without necessarily needing to be holding that portability, if you like. So I kind of think there'll be two different types of people who are buying this. There'll be those that kind of want to hold it as part of, as Greg mentioned, this kind of diversification sort of play, this sort of decorrelated from equities, and it would just be seen as a safe haven without necessarily kind of thinking out, well, what makes it a safe haven, and perhaps you actually want to be holding it yourself in your own wallet. So yeah, I kind of think whilst that's one of the big characteristics that gives it this safe quality, I think people will just hold it for exposure to what their expected price return on it from the fact that it has that quality.
Excellent. That's I think that's right, and it's an unprecedented condition, and gold presents an interesting example, but as we pointed out earlier, holding a bunch of bricks is always going to be tricky for some folks. So that seemed to have worked in that case. Let's talk about the options market in Bitcoin. And I admit to being a huge fan of Amberdata's muscle there. What's been built to try to reflect it, but it can be a tough market to look at, especially from a U.S. onshore perspective, because a lot of it is just not available to us directly, right? So we might even feel comfortable with where the VIX is, right? Or some of us who care even more might think about how skew is moved. As you were mentioning before, dispersion, the difference between index options and stock options as a barometer and as a strategy. Imran, what do you Bitcoin has some really interesting volatility dynamics, and has a trading platform and an exchange that's kind of unique in the world. Maybe you could help people who aren't familiar with it sort of give us a little bit of a peek at what you see and how the market functions. And then I'd like to have Greg tell us how what kind of considerations were taken into place to sort of build the tools that Amberdata uses to analyze that market.
Sure. So, I mean, obviously, Deribit has got around 90% market share, and that is a crypto native exchange. So you have to actually hold your crypto on that exchange, and then you trade it, and the premium is all the margining is done within crypto, either Ethereum or Bitcoin, and that does and it's not regulated for US retail, US customers. Now, the truth is, you've got BITO, which is the futures-based ETF, which was launched well over a year ago, and the options on that are growing and are liquid enough for you to do stuff. So we write crypto weekly reports at Options Insight, and part of that report is analyzing what's going on in the big crypto names. So we've got MicroStrategy, Coinbase, some of the miners. They all trade options, and BITO as well. So there are opportunities there that pop up that are kind of mirrored in what's going on in Deribit options and just in pure Ethereum and Bitcoin options. So there are ways to participate even for US investors. And especially because we look at it and track it on a weekly basis, we can kind of identify if the vol's too expensive or too cheap on any of these proxies. Like MicroStrategy was a great one. MicroStrategy is just a levered long on Bitcoin. It should benefit from the halving because the Bitcoin price tends to go up, unlike the miners that might struggle from the halving because their margin is going to get crushed. So there's relative value plays between things like MicroStrategy and the miners. Even if you're long and bullish Bitcoin, there's trades you can do between those different assets, right? So the space has a lot more opportunities than just playing Bitcoin and Ethereum options on Deribit.
That's a good reminder. I think I'd add to that the Canadian market, where there's great trading on TMX with some of the spot Bitcoin ETFs, and where there are ETFs that are buy rights of other Bitcoin ETFs. So that's good. 90% is a pretty big number, though, and I think pure exposure and I think a focused Bitcoin volatility strategy has to, if you have offshore capabilities, has to include Deribit. So, Greg, tell me how you thought about those different markets. They're at the same time very transparent and sometimes very frustrating. How did you use your options background to sort of try to optimize how to capture information in the Bitcoin and other cryptocurrency option markets?
Yeah, absolutely. Well, first off, we have like a really good relationship with Deribit. Deribit is an investor in Amberdata, and we have our charts directly integrated with the Deribit website. We spent a lot of time figuring out dealer positioning on Deribit. So this is something exclusive to Amberdata. It's a very actionable data point. Essentially, what we do is we tally up the times and sales data of each individual trade, and we look at who the true aggressor is. We have this proprietary algorithm that we've devised with Tony Stewart and Ewan Sinclair. And basically what we do there is we can figure out the true aggressor of every trade, assuming that market makers are passive and capturing spreads. We can figure out how they're positioned. And so this has been really interesting, especially this year. We've seen a lot of the flows of the ETH overrider coming in after the Shanghai upgrade. We saw a lot of Bitcoin call buying post SVB. And so it gives us a really good idea, first on sentiment, how are options traders position in the market, which is a really great indicator, but then also what will dealer hedging flows look like? And although crypto options are still a small segment relative to spot today, we'll see a lot of those flows translated in funding rates, futures basis, things like that. So that's very interesting. And once we get to spot Bitcoin ETF, we'll really see growth in the vol markets, I think. BITO right now is 15% open interest, notional open interest options compared to Deribit. And BITO is a hard product to trade. It's a derivative of a derivative that you're trading derivatives on that has a 30% dividend. That thing is complicated. It's not clean at all. A spot Bitcoin ETF is going to solve a lot of those issues, and it's going to make trading vol like a whole new, create a whole new avenue for US markets.
Oh, that's great. And I think we're coming close to time, but I think what we've covered here is that we want to think about and analyze from a high altitude how central banks have potentially come close to, not exhausting, but have used a lot of the powder that they had to try to solve the world's problems and try to stabilize economies. And these crises don't come up, they never come up at a convenient time, right? So more and more people are going to try to think about fragility and look towards Bitcoin and other digital assets as ways to kind of off-ramp themselves from those kind of risk profiles. We talked about options markets. We talked about correlations and how they might be predicting future risk profiles and future price accelerations. I think we did cover quite a bit, and I think gave a lot of people a lot to think about. Let's maybe do maybe 30 seconds each on final thoughts and what you'd like people to remember the most. And maybe I'll start with Imran, and then David, and then Greg.
Sure. I mean, the ETF, I do believe, is priced in to about 80%. So the knee-jerk reaction on Bitcoin, let's say it happens in January, I think the knee-jerk will be maybe somewhere in the 40 to 42K region. And as Dave was saying, that probably is a sell the news event. But then, as Greg was saying, that probably lasts for like a week, right? So the truth is, if you're not a short-term tactical trader, it's just worth owning this stuff. It's worth allocating. It's worth owning some of this stuff in a percentage of your portfolio that makes sense. But if you're tactically trading it, like I am every week, then I think the much bigger opportunity in the near term, and when I say the near term, I mean in the next 3 to 6 months, is probably Ethereum. And the options market is already telegraphing that.
I see. David, final thoughts.
Yeah, I think my final thoughts is the idea that the traditional fiat monetary system is unsustainable, and it's only sustainable with liquidity and low real rates, and without that, it will implode quite quickly. So the consequence of that unsustainable system will constantly over time be this currency debasement, and we don't see it so clearly because all the central banks are pursuing the same policies over time, but we see it reflected in asset prices, which sort of continue to go up, and ultimately Bitcoin is that the hardest kind of asset, if you like, which is going to be your hedge against that, as well as it having this network adoption, impact, and also the sort of tech play in some of the other things. So it's we're still so very early. There's such a small amount of the global capital that's actually allocated into this space, and we just starting to see the avenues for some of that to come in. So I think it's going to be a really exciting few years.
Fantastic. Thanks. Greg, final thoughts.
Yeah, final thoughts. So crypto and Bitcoin, paradigm changing asset class. No one knows how to value this thing yet. Like David said, the fiat monetary system to me is probably where all losses reside and debasement occurs. And so I think, looking at these data sets, whether you're looking at the vol surface, how do you price a vol surface on an asset you don't know how to price yet? There's no one who's been doing this for 80 years. So there's a lot of opportunity there. So looking at the vol surface data makes a lot of sense. Looking at blockchain data, DeFi data, really there's a lot of edge and opportunity in this market still. Given the sort of thesis that we think Bitcoin's going higher, now what's the best way to play that? And so, come see us at Amberdata. We have a lot of data sets, and it makes a lot of sense for people to use this data to trade and find trading opportunities.
That's fantastic. I want to thank Imran, David, and Greg for a really interesting time on this webinar. And I want to thank Amberdata for bringing the content to the Coindesk audience. We had a great time, and I hope people enjoyed it and learned a few things, and will reach out to the panelists and reach out to us at Coindesk Indices. Thank you so much for tuning in.